very good because I'm in love with real estate. But again, I like, other things. I come from the strategy and financial play. So, we're setting up a company, and then I think a mini, whatever loan company. And then we found out that people that take loans, little loans like, 50K, whatever K, 100K, 500K, the most are people that earn between, that time, I don't know if whatever is still true now, that earn between 1 million to 2 million as at that time. And then we also found out that the people that, categorized as low-income earners in a particular period know how to manage their wealth. Some of them, are you not surprised sometimes when you hear that your driver somehow managed to buy a land in the village, and then you'll be like, look, how much is your salary? How much are you earning? Do you understand? And then you also hear some people, 1 million, 2 million salary, and they still take all the, little loans. What do people call it? Loan sharks, right? And that is financial intelligence, right? And that's the reason why I've been so interested in, teaching financial intelligence. I'll try as much as possible not to get deep into finance. What I just want to teach is, how money behaves, how to allocate your capital, because in all honesty, right about now, Veritasi Homes and all of you are going to the luxury side of real estate. I heard Dr. Gabriel taught you luxury whatever yesterday. And when he said luxury, that buy all of these projects, we can say they are rich people. And most of real estate buyers, 80% of them are not debutant. The people that bought real estate before are the people that keep buying. There are very few first-timers in real estate, right? And because they keep buying the real estate, that means they have a big portfolio. And because they have a big portfolio, that means they are rich. Rich people have the best advisors. They have the best financial advisors. They have the best legal advisors, right? And they get, before they make buying decisions, get information from all of these people. What I want you to do is, this class allows you to think from the demand side and on the supply side. The supply side is from you side, because you're the one supplying, right? And the demand side is from the buyer side, So you're able to say, because look, when someone asks you if if the MPR is 26.2, I think they just reduce it and say, look, if MPR is 26, and I'm taking a loan to buy your property, what is the ROI? How am I sure that the ROI, the spread I'll get from the ROI, will be able to make me cater for the interest rate and depreciation and all of these things. All of this you should know. You should be able to talk about this. So why should I not put my money in Dangote's IPO? I'm sure all of you have heard about Dangote's IPO. Why should I not put my money in Dangote? Why should I buy real estate from you? You should be able to sit down and analyze, and but all of this actually come from being, financially intelligent. I'll try to be fast so that. Okay, that's fine. So, favor here is define financial intelligence as the ability to understand how money behaves. It's not about how much you earn, it's about how effectively you deploy what you earn, right? So, just like I said earlier, it's not about how much you earn, it's how you deploy what you earn. We realized that a lot of realtors have gotten commissions back to back. There was one time, I think it was Xylos, was telling me, setting up an app, because we know that realtors are usually always, before the end of the month, almost always booked, so that we can give them and then we can collateralize it with the next commission. I said, look, what if they don't sell again? And then, he was just very sure that they will not make the best use of that money. And that's the reason why he wants, that system set up. So we said, look, if you're defining financial intelligence, what do we need to know? What do we need to know? We know how, the income literacy, what fraction of the money that comes in is your money, is the one that you should spend. What should you invest? what should you save? How do you save, right? And then we also want to be aware of our expenses, understanding how money leaves your account. What are the things that I buy? What should I, there's one time when, and to be honest, I tell people the truth, even if sometimes it affects me a little. Some people came to my office and said, look, we want to buy your property, we want to use a mortgage, a Nigerian mortgage, and not MREF or NHF. And then I'm like, with a private bank, I said, what's the interest? And the decision in the north of 20 at that time. And I said, look, that's bad decision. You should never do a mortgage of 20-something%. And the guy was looking at me like, but you're supposed to be happy because the money comes to your account. But I'm like, yeah, but I am a financial advisor at the end of the day. Yes, I want you to buy from me, but I still want you to make the best decision. Do you understand? I want you to allocate your capital, because when you buy with a mortgage rate of 20-something%, you would aim maybe times 5, that amount of property. So, and then my job as a realtor is to then create or design a very, more practical way, is expensive, be able to avoid that property. So what I just told him that, look, instead of putting this in this apartment, I think you should buy this one. This one gets the capital appreciation, will help you flip it over or, use it for JV. I'll give you a developer. A developer comes, you get this amount of units, and then you sell this, and then you can come buy this, right? So this is the way I want you to think. And this is from the supply side, right? So capital allocation, where surplus money. Nigeria of nowadays, I really don't think that the surplus, all the money, before it comes in, it has where it's going. In fact, this is the reason why you have to be financially even more brilliant. Right? And then, risk awareness. Every return has a risk and dimension. Compounding, say time plus investment multiplies well. There's something about compound interest that is amazing. In my next slide or third or fourth slide, someone said that compound interest is the eighth wonder of the world, right? Compound interest means, when you reinvest your profits with again, right? And then you allow it compound over time, And there's something, I was listening to this guy, Sam Altman. How many of you know Sam Altman? The OpenAI guy. And then he was saying that when you use time when you leverage time to make money, when you use just time to make money, using time to make money means every income that you get is from your time, right? It's whatever you do with your time. Your wealth, you scale linearly. Linearly means like it grows like this. It's so hard to scale exponentially when but when you use money to make money and then you use compound interest, you scale exponentially. That's the difference between time, and money. The money, works and works. Money works efficiently well when it's used to make more money, right? And when you're compounding it, works efficiently well. When you use time, it's very, we're humans, we're not AI, even AI, right? Time, you go work, everything you spend, especially, this is the definition of all the people that lives in the UK, and there's the reason why when they come to my office and say, oh, I want to move to the UK, I'm like, oh my God. Again, because what happens is, this is what they do, use time to make money, and then that's linear, before achieve financial freedom. They are always almost in their 60s. Do you understand? Because what? Because they are not compounding anything. The money comes in and it goes out as expense, as tax, as all of these things, right? But when the money comes in, there's some that you have saved, there's some that you invest, and I'll tell you, some of the investment strategy and diversification strategy as we go on, right? And then this the strategic investors lens. It said financial intelligence move beyond accounting, ask structural questions about capital. I actually even found that a lot of people that are not financially intelligent are accountants. I have asked a lot of, I'm so sorry, but I've met a lot of accountants, and then, I asked them smart questions, and they've answered me in the most, there's something like that, a smart manner. Billionaire worth of land, but I need 100 million naira premium. You'll be like, Baba, clever 100 million premium. Are you not the owner? It's not liquid. It's not liquid. It has so much equity in that property, and that's what they call lazy equity. It's not working, right? It's compound, but it's not working. It's not. Liquidity is almost everything. So when you prepare a portfolio, you must put an asset class that makes sure that you are very liquid, because liquidity also allows you take good business opportunities. So you know, you're very liquid. Good business opportunities come, like Dangote's IPO that everybody. By the way, they are doing the private placement right now, and I'm sure they're not calling a lot of you people. And the reason they're not calling a lot of you people is because they're not sure of your liquidity. You know, what they call is called a private placement. So when I said the private placement, why did you laugh? You understand? Eh? What? Tell me. Tell me. $50. Anybody that gets, everybody wants. Yeah, tell me.
It's just a guess. It's like the first big guy can invest a particular kind of money.
You're not totally wrong, but you're not right. So you don't with my money. Tell me.
For giving to that tested. That's half.
You are using my ledger to use me back. Yeah.
That are innocent, and it's before it goes to the market.
You're almost there, but I mean, I'll give you $5 out of the $50. Okay, so this is it, right? So that, you know, because I'm still on slide one. I told them that the time, well, I mean, so when a company want to go public, it's a form of listing the exchange. Public means that, look, Dangote Refinery is a private company, right? A 20 billion USD single trade private refinery, right? And there's a lot of all of this fight, regulatory, all of this thing, they want to kill it. And it is thinking, oh, maybe because I'm the only one that owns it, right? What if Nigerians own 10 or 20% of this investment? Would they then kill all Nigerians, right? But then you're listening to the public, right? And then by IPO, that's all of the things that you've been hearing. IPO. In fact, all of the things that you've been hearing is called a non-deal roadshow. You know, sampling you people, like sampling your output, like, what do you think about this? And the feedback is like, you know, the market wants it, right? But IPO means initial public offer, right? So the private placement is now saying, look, hey, Nola, how's it going? This company is going on the exchange month. But as a individual, right now, there's still a private company, you have to take some shares. This valuation, the public then controls the valuation, because the valuation of a company is the value of the share multiplied by the floated shares, right? The outstanding shares. That's the valuation of the public company. But a private company, you can then know the valuation by a different method, FCF, weighted whatever, different other method. So you are taking a pie, a bit from that company before it goes public. Then when it goes public, then you can then sell your shares off at a premium, right? Or wait for dividend. I think the play right now is you keep saying dollar dividend, and everything, and that's what everybody wants. So private placement is for a private taking a share of a company before it goes public, right? At a particular valuation predetermined by both parties. Simple. I'll give myself my $50. So does it increase yield, improve capital velocity? I was going to ask a question there, but and then someone is saying the distinction between people without intelligence and with intelligence is without intelligence, high earners remain financially fragile, and with intelligence, moderate income becomes engine. And this almost everyone is guilty of it. It's not just you. People are they're financially fragile. It happens to people, it happens to organizations, it happens to countries, it happens to different, in cases, look at countries like Nigeria, earning oil, free money, but they're still what? Fragile, because they keep borrowing to fund their budget, to fund a lot of things. One day I was reading about this country called Switzerland. Switzerland, right? Very cold, no resources, nothing. But because of what? The brilliant people that lead the country, they're very financially intelligent, and they're one of the most wealthy country in the whole world. So it's not just individual countries, it happens. Oh my God, I can't believe I'm just getting to slide 2 now. So I just keep some since I am, yeah. So, yeah, the Favor and Co is saying that there are good financial metrics. When I say Favor, I mean my Favor. She's somewhere around. Yeah, she's the one that prepared it. So if you see any mistakes, and she's saying there are financial metrics, that you use, that some people use, brilliant people, asset managers, sponsors, all of these brilliant people in the capital financial market use that you have to, you should know, right? And then ROI, I'm sure that a lot of people know what is called ROI, so let me not flog it. ROI is, what's the profitability on the amount I've invested after I remove what? Holding costs, regulatory fees, delay, inflation. A lot of people actually make some mistake. They calculate ROI without all of them, So you calculate ROI without considering inflation, right? And then I'll tell you something, it's only Nigeria, every that I received last 2 years, or early last year, that is very high, because the inflation was high. Inflation was high, I can't remember and then it's gone really down, right? At least by, what they fed us from, and I said, issue me same invoice. I expect it of what? Gone down, because inflation is now down. Has it gone down? No. Nigeria, only country. Everything, they say it's high, that's why this price is high. Okay, now that inflation is low, why is the price not low? Interest rate is low, why is the price not low? Anyway, so you calculate your inflation, you calculate your delays, and different other little things to actually know the ROI. Yeah. So ROE is a bit more complicated. It's used by companies, right? Because before debt, before other financing, how companies start off or fund whatever their operations, their acquisitions, their CapEx is by shareholders, what? Equity, right? Do you understand? So one of the reasons why this refinery is trying to, like, look, we have funded this project with debt, $20 billion from Afrexim, from banks, from different, but we need some equity in, right? Why do we have to use debt? We need some equity. We need to list. We need to direct funded, and that's the reason why maybe to also even refinance some of our debt. Do you get it? What's refinancing? $50 question. You people must get this one right. You must get this one right. How can you not know refinancing? Eh? Talk to the mic.
It's getting a new loan to pay off an old loan.
You're almost, if you just try a bit more.
It is getting a loan to pay off a new loan with a better interest rate.
My first $50 goes. What happens is, if I get a new loan to pay off my old loan, I'm not refinancing if it's loan. I'm even making my situation. Now it's Ponzi. That's what Ponzi scheme are doing, right? If I've taken money and I'm getting another 5% to pay off that, and I get another 50%, that's Ponzi. That's not refinancing. So it's getting a better financing to pay off, that's refinancing. Actually, that's fantastic. I like that. Yeah. So ROE is how efficiently, right, a company uses its equity, right, to generate. So the return on shareholders' money is called return on equity. The same way this is ROI, right? I would have just loved to. And I'm on slide 2. Say if it does not proportionately your capital becomes inefficient. And ROCE is return on capital employed, which combines both debt and equity. Look, 2 ways to finance operations company, CAPEX and stuff is mostly debt, equity. Depends on however, private placement, IPO, whatever. In the debt side, commercial papers, bonds, different documents that can be issued, right? And all of that, right? To get there, when diversifying, right? So this just rounds up the whole thing. So when you evaluate capital structurally, you evaluate if this asset is attractive. And what does this do to my capital? Improve your liquidity, increase portfolio use, strengthen diversification, I like the word strengthen diversification because it's a topic I'm very interested in, especially in the real estate space. You must teach your client how to diversify. You also must diversify yourself. Everything that you teach your client how to do, you must do it yourself. If you are getting your client to reach out, you must be rich yourself. In fact, let me tell you something. You're trying to reach so much that feel like they've outgrown you. They feel like they've outgrown you. They will not buy property from you again. Yes. They will not buy. Move to the next person that has now matched whatever. It's not even in property business alone. It happens everywhere. So you grow, the business owner. You're talking to some bankers. You also grow. You start talking to EDs. If the banker that you're talking to before is growing, at the point it's like, I want to be talking to the MD or ED, and then you are still here. So I don't want to talk to you like that because you cannot make the kind of decisions at that level again, right? So because your client now is thinking, look, I want to buy properties in Nigeria. I want to diversify. I want to buy in London. I also want to buy in the US. I want to buy in Dubai, right? I need someone to tell. So now you have to tell me how to diversify across geographic regions, not. And then you must tell me the reason why you do that. And then currency diversification must be, and then we must talk about devaluation if we're talking about currency diversification. All of that, wrap, right? Yeah. labor trap versus wealth. I think I have a book there that I'm supposed to, So labor trap, wealth. She say that. Did you put this? Something down that I was going to, but. So it's labor trap, wealth engineering. Labor trap is obviously what a lot of people do. You go to work. You say people do it on the 31st of December. That's the number one important. I put my money in, it's safe, number one. Must be safe, right? Then you then think of the yield. Actually, smart investor, that's what they think. My money, like a rule of thumb about how people from different age brackets should invest. When they said that younger people should take more risk, right? And older people, why? Because you are very near to, why do you have to take more risk? You don't need to put your money in stock or wherever. You just put like bonds and you're good. The first rule in investment is safety. Then second is what? The ROI, the yield. And then the third is different. If you're investing in another country or another space, another geographical region, you then start thinking about repatriation. How easy is it to bring my words, ROI or wherever back? This is the reason why all of the South African companies in Nigeria never really own so much assets, tangible asset. They just come, play really light, come with their IP, intellectual property, and whenever there's any problem, most of the time, they don't make Nigerian banks their major bankers. If anything happens, they just pack their bags and go, So, yeah, so this is the last one, building a portfolio that survives shocks and creates generational wealth. I'll tell you an example before I go to the next slide. So, when USD from, I experienced that, to 1,700 in the space of 2 months, a lot of people's wealth was what? Wiped off. It's very simple. It's just almost, your buying power has now been reduced by 3, correct? Right. And this is the reason is because their portfolio, how they've prepared their portfolio allows them. It does not care us for what? Shocks, right? It does not care us for shocks, and it's not, what's the word? It cannot endure a lot of what? Stress tests, right? So when you have a good portfolio, means you have, real estate assets across regions, you have bonds, you have stocks, you have emergency funds, you have insurance. Your emergency funds is in dollars, the one that you need every day. And then they're also not in direct cash, they're in near liquid instruments, and that's how to prepare a portfolio. And this is not taught by, you learn it. You learn it, right? So I'll skip that one. I think I have to talk about this. Well, how much time do I have? I see, okay, they've given me, yeah. So the four intelligence, so wealth compound structurally when you move beyond transaction, system designs, and capital optimization. That's the reason why I said I like some of the things that the guy talks about, because it talks about systems, talk about structure, capital optimization, protection, holding structure, holding companies. I'm not sure people think that sometimes, some of the companies used to acquire all of these assets should, be out of the country. I'm not sure that, some of your contract also, especially when you're playing in a very difficult region, might not be governed by the law of that particular land. Different things that you can actually use to protect your asset. So income awareness, understanding commission, fees, margins, keep you functional, or transaction, right? Profit awareness, capital efficiency, portfolio architecture. Then, this is what I was saying. Compound interest is the eighth wonder of the world. Who understands in it, who doesn't pay, pays it. Look, compound interest is so beautiful that one day I calculated, the amount of money I used in calculator was much. Let me come a bit to a decent level, right? If you invest $1 billion, at how many percent? Let's say 15%, for the next 5 years, and then you don't take any money out, you just keep rolling over, or maybe you even take a little bit out, but the profit and the money, you keep rolling. The answer, I can't remember now. And when you invest $1 billion at even 15%, but you keep taking the 15% out. So if you invest $1 billion at 15%, let's say the profit is like 150 million, that's before tax and all the rest, right? You know, you take it out, you put the 1 billion back, you take it out. And then in the 5 years, you would have made 750 million, right? However, if you don't take any, let's say you are taking 50 million out, you know, I mean, just for, you know, and then the next one, that means you invest like 1.1 billion, and then you put it there, and then it goes. If I can have someone mass, and you see the difference is so huge. The difference is so huge. The difference is so huge. If someone can do the maths and tell me, the difference is very huge. Do you understand what I've said? And then you don't have to have $1 billion. You can have, whatever cash. I'm just saying that try to play with compound interest. You know, it gives you leverage over, a lot of other, you compound your wealth, your structure, you're good. And I hope you know that you can also use that your instrument, that paper, you can take a leverage against it, to be able to do short-term financing. Do you understand what I've said? Right, so let's say, for example, you've put in a fixed deposit, with an asset manager, $1 billion, and then you don't want to take it out. You need something to just do a business short-term. You can take money against that because that paper is an instrument. It's even a cheaper debt because it's money against money. Do you understand? So just to finance short-term going concerns. So compound interest, I think you should. Yeah. So this is what? That's the difference. You compounded 2 billion and 750 million. Yeah. So yeah. So I'm not sure that a lot of realtors know some metrics, that we use to measure some very well performing assets. People just think, because when you invest UK, in Dubai, all of this, they ask all of these things, right? Some of the key metrics in real estate, very importantly, is cash on cash. Cash on cash return is, I am renting a property, or I bought a property for like maybe 200 million. In case of this, invested capital is 20 million. Annual cash flow is 4 million, right? Your cash on cash is 20. Cash on cash means the amount of money that property produces, right? And the amount over the amount invested, right? And this is the metrics that you then use to know how your asset is performing, right? So if it's more than 20%, it's performing excellently well, and that's the reason why, some people say, oh, I want to go and buy an apartment, before calibrate all the rental, whatever, I want to go and buy a house in Ikota for 200 million, but the rent is 5 million, or I want to go and buy, because if you do 200 million over 5 million, that's like 2%. That's like 4%, right? 5 million over 200 million times 2.5%. What is, yeah. So you should know that it's a very bad investment unless you want to stay in that house. And that's the reason why even people like Robo Kiyosaki argue that renting is more financially brilliant than staying. And I can prove every time. Let me give you an example. Our office in Ikoyi, if you do the valuation, will probably be like around 2 to 3 billion, right? If, people, if 3 billion, right? Let's say 3 billion with the furniture and everything. Let's say we're renting. We try to rent. We can actually rent, so say maximum 100 million. That's maximum, right? Between 50 to 100 million a year. 100 million times 10 years is what? Are you saying that if I have that 3 billion cash, I will not be able to make more than 1 billion off it in 10 years? If I'm smart, I will double it in 10 years. I will even triple it. Can you see how holding on to sometimes assets is, it's not financial brilliance? Do you understand what I'm saying? So you're holding an asset of 3 billion that can be converted to liquid, do other things, to play around other portfolios that are fast, make money. You then rent for like 7 million in the same area, you know, but you're sitting on that asset. How? You need to free some money to do some business and pay your rent and have more money. That's the Kiyosaki's argument. So look, renting sometimes is more brilliant because most of the time, all of your assets should be cash generation asset. There's no point. We are not guilty of this. I mean, the house that I also is worth a lot, you know. But I'm just trying to tell you that why are you sitting on that 3 billion? It can make for you 10 billion in 10 years, even 15 billion, if you know what you're doing very well. With 3 billion, I can buy a land in Ikoyi or do like a JV, you know, and make money and do it like 4 or 5 times or 6 times before 10 years. And I would have turned around the money like 4 times. See? So this is the reason why cash on cash is very important. They talk to you about the property. They talk to you. You're thinking, what am I getting out from it? But in our case, again, another argument is that's looking solely the monetary aspect of things, right? But there's a lot of things that it gives to own your assets, right? You know, Veritasi is in the way, this one, that one, you know, brand equity, different thing, trust, which is fantastic, you know, which you can also get from renting an asset in Ikoyi because you don't need to put it that, oh, this is rented, right? But I'm just saying, like, you look at it from both sides. Do you understand? So most of the time, renting is cheaper than owning an asset. If you're going to, you know, so most of the asset you should own should be cash flow generating asset. That's what I'm asking. So this metric is actually very important. You must know how to use it. See? And then this is NOI. NOI is just very simple. I think they use NOI more in, you know, when you're trying to buy commercial asset like hotels and everything. You know, NOI is just it's a key profitability metric in real estate. You must know it. You know, and these are some of the terms that you say to your clients, you know, that make them trust you even more. You know, so an hotel is producing this amount of income from F&B, from room, wherever, from different stuff, and minus the operating expenses. The bad thing, however, is because we're in Nigeria, and most of the things that run a commercial asset, real estate assets, to loss position is usually energy. So the operating expenses then get increased because of energy cost, and then maybe your NOI is then really bad, right? But NOI is most of the time when you're abroad or anywhere in the world, what you use to calculate, you know, how efficient, you know, an asset is. It's a very key metric of real estate. You must know it. You must know it. You must know it. I think yesterday, do you serve people in class? You know, finance is very, very abstract. So they're looking at what's this guy saying? But look, let me tell you something. When you don't understand something, call my attention to it. You know, I know. Trust me, I know finance is very technical, and you know, it's not what you can relate to every day, or selling, or this, that, finances. And that's why you must know it. You must know it. Look, let me tell you something. When you find anything interesting like Instagram, like all of, those are the things that will ruin you. The things that abstract, yes, you know all those Instagram and you said content, you know, all those bad content. That's the one that will ruin you now. The one that, you know, you just smiling. That's why, you know, you know, we'll just be, and I said, what are you, why are you? Now said, and I said, let me even try this TikTok. I deleted it myself, you know, because just the next one, there's one thing, next one, one thing. In fact, you know, I'll be somewhere, and then maybe I'll find myself in a random country, and I'll say, look, let me even Google like the best restaurant or the best. And someone just told me, no, you just go on TikTok. I was like, TikTok is not your Google, you know. So those are the things that, see, before you know it, you have spent like 2 or 3 hours. So it's the abstract stuff, the things that are boring. Just the same way, all just that the one that suits, send you to hospital. I mean, if you could, I would have brought coffee to you, but you can't, so you must listen. Thank you. God bless you. Yeah, so we've talked about NOI, and we're going to talk about debt. Ask you, apart from this class, how many of you have come to LBS for a course before? One, two, three, four, five. How many people are in this class? 100 or 90? 90. Let's say 90. So out of 90 people, 5 people. That's about 7%, right? So bad. Advise you. And I'm not even joking, right? I have met, apart from Yahoo boys, I don't know how they do it, right? I've never met a wealthy person that's not smart. Even the one that didn't go to school, to meet your ex boss, Okoya, he's very alerted, he understands his numbers, very smart. I don't think he finished from primary school. No. I met a lot different, because of whatever I do, you should expect that I've met great people, All the I've met people that drop out, that, they're very smart, they understand their numbers, especially their numbers. They know P&L statements, all of these things. There is no way you're trying to be wealthy, you're trying to be rich without your numbers. And we're talking about different investment, the diversification. The best investment that you can do is investing in what? Yourself. How do you invest in yourself? By reading. I was telling her yesterday that I read at least one chapter a day. She now said, which is very good, every day. I'm like, no, sometimes, but if I miss it for like 5 days or 10 days, one day I'll cover up for whatever I've done. And it's very easy because one chapter is between 20 to 40 pages from most of the books that I've read, unless all of the books that's this guy, Robert, that, all those war books, which I really like as well. Also, the business is war, and you have to know strategy of. So, is reading. Investing in yourself is consuming a lot of book, the same way you consume content. The investing in yourself. The investing in yourself is knowing how to start and scale a business. Is knowing all of this I've mentioned. Reading, knowing more. Investing is taking out the cheapest in LBS 3 days course. It used to be 300,000 or 350,000. You people, you went 50. That's 100% inflation. A lot of you get commission more millions, right? Multi-millions. That's why all of these people here, you are the best of the rest. You get commissions in multi-millions. You want to clap for yourself? Clap, clap. From that, 670, I'll give discounts. Come, cause the for beginners. It's still here. And then another one called finance for non-finance. finance for non-financial, financial, again, all those courses, you must do it. It's very 3 or 4 days. You come, and the good thing, when I come to LBS, one of the things that I use to console myself is at least if I don't learn it, which I learn, I will eat good food because because they always have good food. Do they have good food? Yeah. So you food the morning and afternoon, at least you cover. If you go to Cali, wouldn't you spend more than 100,000? Simple. So you must come, and that's you have all of these things. 3 days, do it a year straight or 2 years, and see how your life is going to change. That one is not part of this lecture, and I'm not a motivational speaker. So, look, all of these things are very technical for them. Are you sure you want to, So I'll just run through all of this. So he's saying like these financial mistakes that people do, and that you should do. Yeah. So you should never think that revenue is profit. People just spend revenue thinking it's profit. Even the revenue, if you're running a company, a business, you should also know how to recognize revenue. Not all of the money that comes to your account is revenue. That's fantastic. You bought the land, and then ask a general question. If you have money, right, and then you have an option between buying a land somewhere, and buying an apartment that generates cash flow, which one do you think you should buy first? Why? Say something. Oh, Mike, say something. I say it now. Say, don't let everybody hear you. Why is she shy? I just want more. Okay, good. Say something. Give her the mic. I was struggling to hear you.
Can you hear me?
Yeah.
Okay. So, first off, I personally would go for buying apartment. Okay. The apartment is already generating cash inflow, one. Now, if I say, let me buy land and build, with what is going on, I might start, and my cost and estimate is 3,000 naira per bag of cement, and I'll use that to build. But before you know it, inflation...
No, I didn't even say build, right? I'm just saying...
No, I'm saying why I will go for apartment instead of the land.
Okay.
Because if I say, let me buy the land and build the apartment already, let's not forget the apartment.
It's, let me say, 50 million. I can decide what to buy the land and use the 150 million for other bond, other things that can generate my cash flow. So that is it. So for me, I'm not going for the apartments. I prefer the land. Yeah.
Just say that again.
Yeah. But I say, so I'm giving a scenario. Let me say the apartment is 200 million and the land is 50 million. So instead of me to put the 200 million for the apartment and be generate cash flow, because again, by the time you calculate the cash flow, how many years will I use to generate the 200 million? Because that's another thing. But again, if I use the 50 million, the land will definitely generate, and use the 150 million for like bonds, some things that can be generating money for me.
Okay, look,
For me, actually, I'll start by making calculations. I'll look at time value for money and the payback period of the property in question. Then I'll look at the projection of the land, where it is. So once I do that calculations, the calculations will guide me where I'm going to get more money in the long run.
okay, thank you so much. The reason why I asked that question is because I actually do not want you to rush into the answer and say, apartment. I wanted you to say something like some of the things that we've been taught today. Like, look, what location is the land? What is the one, right? If, however, my equity is going to be tied down in the, I also want, in case of apartment, also want you to tell me about your cash on cash ratio. Like, what's the revenue that it generates per year? Service what I've invested. Am I in a losing position or not, right? But all in all, what I want you to choose anytime you're faced with two situations of starting to generate cash flow at the start or a capital appreciation, which is passive value situation for you, but everything, getting flow immediately, because again, like I said, cash flow is life. It makes you do a lot of things, take better decisions, take good business opportunities, plan your finances. You should cash flow over future capital appreciation, right? But there's a lot of other possibility. I'll tell you. So one time, someone came to my office and said, look, I want to buy, I want to be renting one, and I want to live in one, because I want to, I said, what do you have? He said, well, it doesn't have a lot of money. I tried to get an idea, but there was no good deal. So I said, look, what you should do, I think that it was around Ikate. I said, buy land, I'll help you find someone that will develop that land, right, as a JV, right? And we made sure we structured the whatever. I think they built like 12 units, and then he was able to buy the land, and then the developer came, I think gave him 5 units, I can't remember, and took 7 units. Well, we did a lot of risk assessment because again, developer might not also build, right? And then eventually got 5 apartments, right, out of. So look, from the 5 apartments, he stayed in one, he sold 2 to get it. So you get some apartment for yourself, you rent one, you sell a few, you get more cash, you repeat, you rinse and repeat. Before you know it, you have built a wonderful portfolio. But again, let me go say the face between getting something that gives you cash flow immediately and whatever for valuation. Take the cash, right? Then later you can then build a portfolio that will put. Not to say that you're wrong. You're not wrong. It's just from experience and from yeah. So thinking about that from being a realtor to someone that people come to say, look, I have 2 billion. I want you to help me, and then you. So very important. These are some of the best asset classes in the world, anywhere in the world, across regions, across anywhere. These are bonds, stocks, commodities, real estate, and some people hear cash equivalent. Bonds are obviously I would love you to put this here and this here. Fixed incomes, right? So bonds are. I'm sure you've seen Veritasi commercial paper. As some bonds are what corporates or companies or countries issue, to the public to borrow money to run their OPEX or CAPEX, right? This is very technical, but I want you to listen. So the owner of the bond is the investor. Bonds attempt to be very risk-free, especially when it's invested in countries, right? So for example, if I'm holding a Nigerian bond or an Angola bond, the only bond that's crashed in the last few years is Ghana Eurobond. I'm sure you heard about it when a lot of investors lost money. But I think they're restructuring right now. That's one in like 10 or one in like 50, So the bondholder owns the bond. It should be in your portfolio. It should be in your whatever portfolio, right? It's tradable. Meaning it's tradable is that you can sell it at a secondary market. But a good portfolio must have fixed income, So, if I could write, I would have, put it. No, you can't do that to me. You can't do that. You can't do that to me. You can't do that to me. 15 minutes. The last person did 2.5 hours. I was there waiting. You can't do that to me. But I'll be a bit quick. So that's So bonds are fixed income are bonds, commercial paper, treasury notes. All of this debt instrument that you can hold and trade. I think the only fixed income that is not tradable is commercial paper. And I think last week or last 2 weeks, I read in the news that there's a CP that is by Dangote that was listed on the exchange. That means, so people, investors can exit quickly. That was the only risk. When people are in my portfolio, one of the reasons why I also don't put money in people's CP is because I feel like the exit is very, very hard, right? But now it's tradable. I can go on the exchange and sell it, secondary market. Then it's a very good one. You must put it in your portfolio. Then stocks, obviously. If I go into talk about growth stock and all of this stuff, but I think one of the reasons why investors right now, the stock market, Nigerian stock market, is one of the best. People are making money, from MTN, from Seplat, banks, Fidelity. I think I bought Fidelity. I bought Sterling at 4 naira, exited at 9. I can't remember, 7 or 8 naira. I bought Fidelity. I'm still holding it. I bought Fidelity at 9 naira. I think it's like 19 naira now. I can't remember. we bought Providence at 3 naira. I can't remember how much that stock is right now. So stocks has its own risk. So any investment, wherever that is high risk, also has high return. So what happens is you can hold, because I think I bought Owando at 60, competitive. I sell it in 2 weeks. And one of the aim of investing anyway is quick conversion of assets to liquid when I need my money, right? Since a lot of my money I'm not in this, or cash equivalent, which is nearly. So you are supposed to know about all of these territories so that you can answer better questions. Why are people buying houses in Katy and Richmond? That's because it's oil and gas area. You are closer to the people that do oil and gas. That's the reason, Do you get it? So you compare it to London, the only advantage that in British real estate has over Nigeria, and I'm saying it, you can televise me anywhere, is for the protection, because a lot of things has happened in years, decades upon decades. Britain is a very stable country, right? It's stable. So people have owned properties there for 30, 40 years. It's still there. Nothing happens. No war, no this, right? Very stable, And also the currency, very stable as well. And also, if you put a house for rent in London, you will most likely get a tenant in 1 week or 2 weeks, because there's so much working population and there's very few houses. So they want to quickly, you want to buy, you want to sell, very, very tough. Before you double your whatever, it can take 14 years. Yes. While in Nigeria, someone will buy an apartment in Ikate for 60 million, and in 2 years or 3 years, yes, we know that is not the correct way it should be. But yeah, you cannot take it away from the market. See? What? It's what it is. You can't take it away from the market. Do you get it? So you must learn all of this. So when you're diversifying for your clients, you diversify across geographical regions, across different asset class, commercial property, residential, industrial, good lands, different. You make sure that when you do all of this, they know that you know what you're doing. And when you do all of this for them, please do it for yourself as well. Yeah. So stock react to earnings and market sentiments. That's how stock grow. Market sentiments, the news, director dealings, all of these things. React to interest rates. MPR going down, rate of borrowing going down. So your interest, your yield on bonds also would go down. If you understand what I've just said. Do you understand what I've just said? You don't. See, new development, geographical regions, emerging corridor, policy stable zone, cross-state assets, currency, this is very important. I think you should. Also, in fact, this is one of my best slides, liquidity, right? So you want to have emergency funds. How many of you have emergency funds? You do? Oh, I'm proud of you. Yeah. Who again? What? Piggy vest? REIT. Real estate investment is REIT. It's not. Are you sure that your 20 million that you've put in your is going to be your 20 million converted or higher than that? This is what it is. I'm not sure. My 20 million I go to, there was one time I made 30% in 3 months on M10. And there's also one time that I lost, with Owando, So you cannot refer to that as emergency funds, right? And cash equivalents, cash equivalents, cash or cash equivalent, near liquid, whatever instrument, like fixed deposit or whatever. I can just call them and say, look, convert my FD into cash. I get it. That could serve as emergency. REITs, to be honest, I don't. That REITs in Nigeria? Yeah, I think, which company owns REITs?
Some about 3 companies. So you get into
Which company? Started again. It started again. When I say REIT, I mean SEC-regulated investment instrument. Not what are you telling me? Zelos is my brother. Don't let me say, So all the portfolio funds today grows tomorrow. One of the smartest structure is not chasing the highest return. It is building a well-diversified portfolio. Look what, it's one of the smartest structural and wealth building is not chasing the highest. 5 minutes, okay. Okay, I'll do something. That's supposed to be true. However, everywhere in the world, in Nigeria, even some of the smartest investors, like myself, still chase the highest returns. I go into the market tomorrow, I put my CP at, now I think the bond market is currently doing south of 20%. I put my CP north of 22%. Everybody flocks me with money. It is like that, People still want yield. They want, why one of the Eurobond in Ghana was catastrophic was because take the picture, even if I don't tell you, just take the picture of this. Take, quickly. Huh? Favor, do you want to give them the slide? Kasha, no. Oh yeah, we'll get the slide. Okay, so yeah, I'll just rush the 4-pillar portfolio model. All of these things that the LBS told me to talk about, I've not even talked about half of it. You're the one that sent me and you're still chasing out of the class. But don't worry, I understand that time is of essence. So take the picture of this. We've set down portfolio management. The 4 pillars of portfolio model is income producing asset, development plays. We've tried to plot into real estate, near liquid assets, growth assets as well. And then portfolio management principles, how your allocation comes first, resources, then your protection, down from downside effect, so when you're rebalancing, because you always have to be rebalancing, and you're guiding your margin, and then you're compounding, if you see, when we're talking about portfolio management, diversification, every time, we always talk about compounding, because how to build wealth by compounding. To build wealth, not even wealth alone, even building knowledge. Building knowledge, you're compounding, you are reading, you are doing this at a point. So meaning that if she reads one book and the next time she reads a book and the next time she reads another, and then you're reading back to back every month, you know, and you come out 5 years, even though she's not, the difference between whatever you have in your and whatever, your decision-making ability, how you navigate problems, your financial intelligence, is very different. So wealth compounds, everything compounds, especially when you do it, back to back. That's how to achieve greatness, in anything. There's still a lot of slides. Okay. Before I do the conclusion, right? There's one thing very important that I'd like to talk about, and it's there's a book actually on it. It's called OPM. OPM. It's yes, it's by Robert Kiyosaki. Robert Kiyosaki is one of the guys that love using debt to scale. So again, you either use debt or the other one, which is equity, right? But when debt is cheap, when it's necessary, but you must do something to scale, right? All of the skill, all of the properties, all of the margins, all of the wealth that you are will be achieved with only your money, your own personal money, or only your time, or only your resources. You must learn how to leverage other people's money, which is, most of the time debt, or other people's resources. Someone has a land, okay, look, someone has a land, right? I've gone to me for JV, right? Or I want to do JV, I signed the JV, number one. And then someone like BRG or whoever has resources of people, of marketers, people top that can, I've created a good, I've told my architect, look, I want you to design me a wonderful project on this land, right? Don't worry, I'll give you some percentage of the profit. I don't have any money now. I then take that project to BRG. I say, look, BRG, I need your people to help me sell, market this off plan, right? This is what I'm going to give you, right? And he said, okay, no problem. This is what I give you, right? People decided marketing. People started their resources. See what I've used? I've used OPR. This is other people's resources, the land, right? Also, the intellectual, other people's time, right? And the talents, right? And then, look, other people's resources again, which is BRG, right? And then money, which is the off-takers' money to then build, right? That's the reason why people say, look, every time, it doesn't take money to build a business, right? You just have to be smart, discover the problem and leverage the relationship and whatever other resources and whatever around you. See? So you must learn OPM. Let me repeat myself. All the monies, all the wealth, all the things that you want to achieve in life, your time is not enough. Resources is not enough. Your talent is not enough. Your money is not enough. Some of the big borrowers in Nigeria are the biggest companies. Go on the FMDQ, Qualico is always borrowing commercial papers, bonds. The good thing about the borrowing is it's used to finance projects. It's not borrowing to buy private jet. Viable projects, right? So other people's money, always, other people's resources. What he wants to do now, equity resources, right? So you have to learn how to use and time, resources, money to make work for yourself. It's a talent, and you must say. And one other very time up. Wait, minutes, please. Yeah, 3 minutes. Yeah. No, it's a time up. Yeah. So one other thing that I think you should do is stakeholder management, right? So if stakeholder management, everyone that matters within your your clique, your environment. If the current president right now, if there's anything that he has done right, while I was just coming here, I read that some other 2 governors has defected to APC, right, which is making it like